I've got a special guest. We got a lot to talk about. Let's begin.
This is Debt Free in 30. Here's your host, Doug Hoyes.
My guest today is Jeff Rubin, who is the chief economist at CIBC World Markets, where he worked for over 20 years. He's written a number of books, including Why Your World is About to Get a Whole Lot Smaller. That was back in 2009. And in September 2020, you may not remember this, but you were actually a guest on this podcast where we talked about your previous book, The Expendables, how the middle class got screwed by globalization. Of course, in 2020, we couldn't leave our houses. You remember that? We all just stay home. So we recorded that episode over Zoom, links in the show notes. So I'm pleased to have Jeff Rubin here in person in our Toronto studio today to discuss his latest book. So Jeff, welcome. Thanks for making the trip to King and Young.
Great to be here, Doug.
Thank you very much. So back on episode 317, we discussed your previous book and your new book, which we're going to talk about, I think is also a cautionary tale. You would probably agree with that characterization. Mm-hmm. You did mention the word globalization in this book 19 times. I did count it up. Okay. So more in the previous book, I think, but there's obviously a lot more to it than that. So we're recording this on May 10th. Your book will be released on May 14th. So by the time people watch this, your book will be available Amazon everywhere. So the title of the book, A Map of the New Normal, How Inflation, War, and Sanctions Will Change the World Forever. Now, your rep sent me a copy of the book. I've read it. Very well researched. This took you a while, I'm guessing. There was a bunch of stuff in there that I already knew, but then there was a bunch of stuff that I kind of scratched my head and go, okay, I didn't quite make that connection. So the title, again, Inflation, Sanctions, and what was the third one? War. So I want to talk about sanctions, which was the most eye-opening thing to me because I just did not make that correlation as well. So what I want to do today is drive this down to the average person's level, okay? I don't care what the central bankers think or the politicians or anything like that. This is the average guy. So first question, you've been on book tours many times. Everybody always asks you the same question, so I'm going to ask you the same one, which is why? So why did you write this book? Why are you not up, fishing up north and enjoying retirement? What was the reason for writing this book?
Well, Doug, as it turns out, and this is the reason why it took me twice as long to write this book as the others, I originally was approached by my publisher, Penguin Random House, to write a book about what the economy would be like coming out of the lockdowns from the pandemic. And it was going to be called, Is There Any Light at the End of the Tunnel? And after about 4 months of starting to write it, events superseded that. You had the Russian invasion of Ukraine, and you had all of a sudden, the largest explosion of sanctions since World War I, World War II. Okay, so it sort of meant that the original project was superseded by far more important things. I was able to retain the first couple of chapters from the original project, which deals with how the pandemic affected global supply chains. But then, segued into this and hence explains why it took 2 years to write it.
Well, and the world keeps changing. That's the other problem. So let's start by talking about inflation then. So before we turned on the mics, you and I were chatting about our old pal Milton Friedman, who cannot be on this podcast because he's no longer with us. But he said that inflation is everywhere and always a monetary phenomenon, which in simple English means the more money you print, the more inflation you get. I mean, is it as simple as that, or is there more to it than that?
There was, of course, as you've alluded to, an explosion in the money supply in Canada and elsewhere. That explosion was driven by the need to pay for all these government bonds to finance these record deficits. And they were paid for by the central bank, who literally just cranked up the printing presses. M1, the narrow money measure, grew by about 40% during the pandemic, 6 to 7 times its normal pace. So that created a very fertile ground for inflation. It was like a powder keg just waiting for a spark. And it got all the sparking it needed to get blowing sky high by the most sweeping sanctions against the world's number one grain exporter and the world's number one energy exporter. So when you sanction the exports of the number one exporter, it has consequences on the prices of getting substitutes for that.
And all of these consequences, I liken it to eating a bag of cookies. I eat them and I feel great, but if I eat a bag of cookies every day for 2 years, I got a big problem. So there is a time lag to all of this. Is that correct?
There is. And usually in a sort of the chronology of inflation, it starts in food or energy prices. Certainly all the OPEC oil shocks, all the oil shocks we've had for the last 40 years have been the spark of inflationary episodes. But then there becomes like an inflection point where all of a sudden it's not food and energy prices continuing to rise anymore. They're not going down, but they're not rising at the rate that they were. But now it's seeped into wages. It's like a cancer that metastasizes from a local tumor and then spreads throughout your body. Well, once it gets into wages don't just feed into the price of food and energy. Wages feed into the price of everything. And that's what we've seen now. We've seen wages now growing at 4 to 5%. So it's core inflation that is now running well above headline. It was the other way around with food and energy. Core, of course, excludes food and energy. And, workers have much to catch up. I mean, grocery bills last year grew by 11%, 5 times their 20-year average. So, maybe the central bank doesn't care about food and energy prices, but for most households, going grocery shopping and filling your tank pretty well defines your cost of living.
Yeah, and the poorer you are, the bigger a percentage of your income,
of course,
is food and energy. So, okay, so here's what I don't understand. We got our pal Milton Friedman who says the more money you print, the more inflation you have. But then obviously energy has a significant impact on that because energy is part of everything. It doesn't matter what you buy, energy was used to make it. So if I'm looking ahead, because I don't really care about the past, I want to know what's going to happen tomorrow, right? So I've got this chart that I showed you where, okay, well, if the money supply goes up, then inflation is eventually going to go up. But the money supply, we had the big peak into the pandemic and afterwards, and then it's kind of collapsed since then. So does that mean that over the next, let's say, 6 months, we expect inflation to ease? Or is it this, oh no, this energy thing is gonna keep it high? What do you think is going to happen in the future?
I think that while headline inflation has peaked, and we saw inflation rates like 8-10%, the likes of which we haven't seen in 40 years since the OPEC oil shocks, we're not going to see that. But what we are going to see is core inflation continue to rise and to run at rates well above the central bank's 2% target rates. So the question then becomes, are those 2% target rates of the Bank of Canada and the Federal Reserve Board, are they still valid? Because the world is quite different than the world in which those target rates were first adopted. And the biggest difference is, of course, the world is in a global economic war. Sanctions aren't a passing thing. They're part of the new normal. I mean, it could well be the case that the military conflict in Ukraine could be over in 6 to 10 months. I mean, if Trump wins the election, it'll be over very quickly. But that won't be the end of sanctions. Even today, like Biden's talking about another 20% tariff against Chinese goods, and nobody would be taking the sanctions off Russian goods. So they're part of the new normal, and they have consequences. And they have consequences not just in terms of the geopolitics of the world. They have consequences for you.
And that's what I want to talk about. And that's what your book is all about, because you draw all the connections between this, and this, and look how it comes in. So my prediction last December was that inflation, and of course I was loosey-goosey on I didn't say core or not, and you got to keep your predictions really loose, right? So that you're always right. It's like me predicting the Toronto Maple Leafs will win the Stanley Cup. Well, I'm not going to give you a date on it. It won't be in you and my lifetimes. We're old guys. So I predicted that by the end of the summer, the inflation rate would be 0. Now, you think I'm crazy on that one?
I think that inflation is going to prove to be very resilient. Okay. I think it's not going to be possible to wrestle inflation down to 2% and keep it there. So the $64 million question is, should central banks try to do that? And that's going to determine how much you're going to be paying for your car lease or your mortgage.
Which is why this is important for the average person. So what does the central bank do to make inflation higher or lower? Is it as simple as, well, they print money and they play with interest rates?
Well, I mean, how do they? What they do, their way of bringing inflation lower is to create more slack in the labor market. And creating slack in the labor market is a euphemism for firing people.
Making unemployment
higher because that's what you need to do to deal with wages. Now, in the old world, before sanctions, there was a real simple solution. You go on strike, fine, we're moving the factory to China. Okay. And instead of paying $15 an hour, we're going to be paying $1.50 an hour. It's hard for inflation to swim upstream against that kind of arbitrage. But that's not possible anymore because of friendshoring. We're only going to trade with our friends. The only problem with that is our friends are all high-wage economies just like our own. So it may make sense from a supply security standpoint, but it doesn't make sense from a price cost standpoint.
Yeah, and we saw that during the events of 2020 because, we don't have enough masks and ventilators and all the rest of it because we don't make anything here.
Exactly.
And so it's like, okay, well, we're going to go offshore to get them. But now if we're mad at everybody offshore,
we got to make them ourselves.
And if we make them ourselves, we're paying $20 an hour, not $2 an hour.
Exactly. So what does that say about the price of whatever
up
we're
it
making?
goes? And so is that the main reason you believe inflation is resilient?
Absolutely.
It's as simple as that. Okay.
And what I'm suggesting is that the imposition of these sanctions and tariffs and outright sabotage, like blowing up the Nord Stream pipelines, this isn't just a temporary blip. I mean, the war in Ukraine may be a temporary blip, but this type of global conflict, economic warfare, we're in the early innings.
Yeah, and you talk about it in your book. Again, A Map of the New Normal. Everyone should read it. And what you say in the book is, it's not like the guys overseas didn't see this coming. Yeah. Russia, China, they've all been preparing for this for years by, bringing more production in-house and getting out of treasuries and getting out of the banking system and all that. So what if I am an average guy or girl watching this thing then? So what you're telling me is, okay, inflation is going to be resilient, which is a fancy word for meaning it ain't going to 0 and staying there. So a year from now, 2 years from now, 5 years from now, it's more likely to be much higher than 2% as opposed to much lower than 2%. And it also means that wages perhaps will be higher, but there'll be fewer jobs.
Well, I mean, we'll see if central banks want to make that trade-off. And that's why I asked the question, before throwing a couple 100,000 people out of work to get an improvement on the inflation rate, is this target achievable? Because if it's not achievable, then we've thrown those 200,000 people out of work in vain.
For nothing.
If it is achievable, then that's a value judgment, okay, that the central bank has to make. And because I'm saying the economy today is an entirely different animal than the economy that those target ranges were designed for.
Right. It was a global economy, and it's a little bit less global now. So if your pal Tiff Macklem is watching this, and I assume he isn't, but let's assume he is, would you be saying to him, forget about the 2% target?
Yes. I mean, I'm not questioning the legitimacy of targets per se. I'm questioning the calibration of today's target because it's acting as if nothing has changed. And I think everything has changed.
Gotcha. So would you say to him, well, why don't you make the target 4% then? Or whatever. I mean, we're making up numbers here. And by doing that,
the target's going to have to be substantially higher than 2%. Whether it's 3%, whether it's 4%, is second order importance, but it's going to have to be significantly higher. And then that, of course, will change the kind of trade-offs that the bank would be prepared to do between unemployment and inflation.
Now, there's two players in this game. One is fiscal, one is monetary. So we're talking about monetary policy, right? Making interest rates higher, lower, whatever. But there's also the fiscal side of it. So again, if whoever the prime minister is today, when this airs, would you be saying to that person, we got to get deficits under control or not?
Well, you see, I'll tell you what, Doug. Normally, in the past, there was a checks and balance. There was an equilibrium. And it was something that I was intimately acquainted with because I would go and travel around the world after every Canadian budget to try to sell Government of Canada bonds because that's what a chief economist of an investment bank does. In those days, there was a check. The more the government borrowed, the bigger its deficit, the higher the borrowing cost. The higher the borrowing costs, the more of your tax dollars goes to debt servicing and not to vote-getting program spending. So that was sort of the checks and balance, okay? Taxpayers knew that if the deficit was huge, that was going to result in higher mortgages because they're priced off the Government of Canada bond curve. But a funny thing happened in the pandemic. During record deficits, the highest we've seen as a percentage of GDP since World War II, instead of borrowing costs skyrocketing, which they normally would have done, they sank to like record lows. I mean, like a 10-year Canada bond was 0.5% yield. So you have to ask yourself, like, why would pensions, insurance companies, retail investors, the people who normally buy bonds, do that? And the answer was they weren't buying the bonds. The Bank of Canada was buying the bonds and at ridiculously high prices to get these ludicrously low yields. The price of a bond and its yield is inversely related.
Yep.
So that took that took the natural constraints off governments. Governments could spend as much as they wanted to. And they did. I mean, Chrystia Freeland tabled, something like a $330 billion deficit, and then had the audacity to brag that debt servicing costs were at almost record lows. But she didn't mention that was because she was ordering Tiff Macklem to buy the bonds at ludicrously low yields.
Yeah, if interest rates stay at zero, I guess debt doesn't
exactly,
matter.
But that's not the case.
case.
You could do that. Nobody was complaining, okay? Because don't forget, first of all, the deficits were being created by handing you huge checks. Mm-hmm. And secondly, when long Canada bonds are 0.5% yield, all of a sudden 5-year mortgages are below 2%. So no one was complaining. But they could only do that. It depended on one thing and one thing only, inflation. And when inflation was below 2%, no one was complaining. But all of a sudden, when inflation was 7-8%, the emperor has no clothes. All of a sudden, central banks couldn't keep the printing presses going. And we've had the biggest correction in government bond yields since the American Civil War. Yep. So now, you want to run Chrystia Freeland? You want to run another $300 billion deficit? Tiff Macklem ain't going to finance it. So the old checks and balances, what I'm trying to say, is coming back into place.
I mean, she's got it down to $40 billion. So it's it's all good now. I mean, it's down to $40 billion forever, but it's down to $40 billion. So what that tells me then is, and you're right, the bond yields have been creeping higher. That kind of proves my point about the bag of cookies. It takes time. So we printed all the money in 2020 and 2021. We're paying for it in 2024 and beyond. So if I'm the average guy, mm-hmm. what is the advice you're
okay,
giving
the
me?
biggest thing you got to realize is the Bank of Canada is not. Let me repeat. The Bank of Canada is not going to be cutting interest rates. Now, right now, we have what's called a yield curve inversion, which is a very particular alignment of interest rates. Normally, long-term interest rates are well above the bank's short-term target.
Which is what makes
Today,
sense.
they're 150 basis points lower. Why? Because the bond market is expecting multiple interest rate cuts. Now, at the beginning of the year, the Bank of Canada was expected to cut interest rates no less than 6 times during 2004. Now it's 3 times. By the summer, it'll be no times. And once that happens, the curve will not stay inverted. It goes back to a normal slope. You could be looking at as much as 1.5 percentage points higher on, say, the price of a 5-year fixed-term mortgage.
And as you already said, interest rates up, bonds down.
Yep.
So you're not.
I
telling
wouldn't
me-
want to be in the bond market, particularly not long duration bonds, because it's no longer the Bank of Canada buying them.
So, okay, we're not investing in, this is not investment advice, anybody, but so you do not believe there will be an interest rate cut in 2024?
No, and if there is not an interest rate cut, there will be a very significant, maybe 150 basis points, 200 basis points increase in 5-year and 10-year bond yields, which will not just impact the government's debt servicing costs, it'll impact your mortgage.
Yeah, because mortgage rates are very closely tied to the 5-year government bond yield.
Exactly. They're priced off the Government of Canada curve. Now, there's a big spread, but nevertheless, they reflect underlying movements. And the mortgage market is a very dangerous place right now for both borrower and lender. 30% of all the mortgages out there by CIBC, my alma mater, TD, BMO, have what's called negative amortization, $130 billion in mortgages, which means that your monthly payment doesn't even cover the interest cost. The unpaid interest gets capitalized onto your mortgage, so that instead of paying your mortgage off over time, your mortgage gets bigger. At the same time that housing prices are falling. Reminds you of something? Maybe 2008, the subprime mortgage market. You know what happened then?
Not good.
People just defaulted.
Well, and I happened to be in the bankruptcy business, and our busiest year ever was 2009.
Yeah.
And the number of personal insolvencies in Canada in 2009 was around 150,000. We've never gotten back to that level.
Yeah.
Even with the population
Yeah.
going up, we haven't. So if I own a house right now and I plan on living in my house for the next 20 years because I got a wife and kids and 2 dogs and all the rest of it, you would be suggesting that I lock in now?
What I'm suggesting is that mortgage rates are going up, not down.
And so going variable does not make sense.
Sure. There is always going to be a business cycle. At some point, we will have a recession and interest rates will fall. And that's a great time to lock in your mortgage as long as you haven't lost your job. But until that point, interest rates are going higher. We don't need the Bank of Canada to raise interest rates. All they have to do is not cut interest rates, and mortgage rates will soar because the bond yield curve will not stay inverted.
Because everything's based on perception of, what's
Of
gonna
them
happen in the
cutting. So
future.
once it becomes apparent that resilient inflation is not going to allow the Bank of Canada to cut interest rates, then 5-year yields won't stay 125, 150 basis points below the overnight target rate.
Are we in a recession now?
We're not right now, but, at some point we will be, and that's always the best time to renew a mortgage. Again, provided the caveat, you're not part of that recession.
Right. So if you were the guy who declares a recession, you were the NBER in the US or whatever, how would you know if we were in a recession? Because I know the standard definition
Well,
is
the typical
negative GDP.
The typical thing is consecutive quarters of GDP, but in terms of affecting economic behavior, because not every actor in the economy watches the monthly GDP numbers. The jobless rate's about as good as any measure, and that's something everybody understands.
And so if the unemployment rate becomes
like 8.5%,
pretty obvious we're in a recession.
Then whether it's technically a recession or not, the Bank of Canada will respond, and then they will cut rates.
And so, but you're not expecting that to happen this year.
No, it's not on the horizon. I mean, in the EU, it's already happened, but it's not on the horizon in Canada and the United States at this point.
Check in 6 months.
We'll see. I mean, but they're always, the business cycle is not dead. But I'm only saying that in answer to your question about timing mortgage renewals.
Gotcha. So, okay, so back to the average person then. You're saying that you do not expect interest rates to be going down anytime soon, unless we have some cataclysm and we're obviously in a recession or something like that. And in that case, it probably means you've lost your job. So you got much bigger worries than other things. Does it concern you that credit card debt is higher than it's ever been in this country?
Well, why do you think that happened? I mean, one of the funniest things during the pandemic is the governor of the Bank of Canada was, while he was buying $3 billion worth of bonds a week, was scolding Canadians for gorging so much on debt. But that's like a doctor admonishing an obese patient while offering him or her a fourth piece of coconut cream pie. I mean, what the hell did the governor of the Bank of Canada think would be the response to these record low interest rates? People would borrow. Yeah. Is that so antithetical?
Well, and it's also, my food costs went up 10%. My wages didn't go up 10%. How am I going to?
Well, that's why wages are now chasing it. I mean, food and energy was the spark plug.
Well, and we all remember his press conference in July of 2020 where he said, I'm never raising interest rates ever, ever, ever. Yeah. They're going to stay low for longer.
Now, all criticism of him, and there is much to criticize, can equally be applied to his counterpart, Jerome Powell, at the Federal Reserve Board. Because basically, the Bank of Canada takes its cue on timing and size of rate hikes or rate cuts from the Fed.
Yeah, what we're saying in Canada applies in many other countries as well.
Absolutely. This is not a uniquely Canadian issue.
Right. So back to the main question then before we close, which is, okay, you're talking to the average person. You're saying to them, well, interest rates are not coming down in your view. So do with that what you will. I guess the obvious things to do would be reduce your debt, because if you have lower debt, it doesn't matter what the interest rate is. If it's possible. Obviously not always possible. That's why people come in to see me. And you can decide what to do on the debt that you have. Do you lock in? Do you go longer? Whatever. Unemployment is likely to ease upwards. What do you think?
I mean, in any historical standpoint, unemployment rates are very low. Okay. And we're seeing a good thing. The thing I talked about in my previous book, The Expendable, jobs, good paying, middle class factory jobs that we thought were gone forever. Guess what? They're coming back, because that's what friendshoring and decoupling does. So, maybe this will be a reprieve, a bit of a reprieve for the middle class. But, wages are going to be, the purchasing power of wages is going to be under attack. And I think that unions, quite rightfully, and I think the curious thing is they're enjoying public support, the likes of which they haven't seen for decades, are going to use their market power for a change and go on strikes. And we're going to see strikes become the new normal, because you can't just close that factory and ship all the jobs to China anymore.
Yeah, that safety valve is gone. And so if I was 17 years old and you were giving me advice, would you be saying, hey, career-wise, being an electrician or a plumber or somebody working in a factory is not a bad thing?
Right. I think we're going to see the return of, as I say, middle-class jobs that we thought would never come back, because that's what international trade did. It arbitraged between $15 an hour and $1 an hour. But international trade doesn't work anymore.
Yeah.
What got crushed was not the Russian economy. What got crushed was the global trading order that we were told was the basis of our collective prosperity for the last 40 years.
So is your message hopeful?
It's neither hopeful nor not hopeful. It's the ability to understand what's really going on, because we see things today through our media, through the fog of war.
Mm-hmm.
And it's not always easy to get a map of what the new normal would look like. But I think one thing is increasingly clear. We can't go back to the old normal. It unfortunately no longer exists.
There you go. The book is called A Map of the New Normal. My guest was Jeff Rubin. Jeff, thanks for being here
My
today.
pleasure. Great interview, Doug.
So, the book, A Map of the New Normal, How Inflation, War, and Sanctions Will Change Your World Forever. And like you just said, the point of the book is to give a clearer understanding of what's really going on in the world. I kind of like that. So if you're interested, buy the book. I will put a link in the show notes. And a reminder, if you haven't watched it yet, our latest documentary was released on YouTube on May the 8th. It's called Debticized, How Our Reliance on Credit Leads to Price Inflation. It's getting rave reviews. Check it out on the Debt Free in 30 channel. That's our show for today. Until next week, thanks for listening. I'm Doug Hoyes. That was Debt Free in 30.